All right. Hello, everybody. Welcome back to the channel. We are here for the third edition of Deep Dives, which is a new series that we've started on the channel, trying to pick one stock per week and use the collective crowdsourced information between retail investors, which have had pretty good year so far in 2025, to try to figure out new companies, new investment ideas, and things that we can all share in terms of our crowdsourced information. I'm here today to talk about Lemonade Insurance with Jake, Paperbag, and Neil. It'll be a fun discussion. Jake, Paperbag, Neil, thank you all for being here.
Thanks for having us.
Yeah, thank you for having us. It's great.
It's a pleasure.
Yeah, Jake's been watching the channel for a while, so super cool to talk to you in person as well. I think the really cool thing about this series is that retail has started to find a lot of big names: Robinhood, Hims, Palantir, Oscar as of last week. I mean, like these names that are just popping up and really changing people's lives as investments that people can obviously increase their livelihood with, their financial mobility, but they're not bullshit stocks. They're not just, hey, let's buy this so it goes up. And there's a real thesis behind it. I think that's what's, making retail investors more sophisticated. So let's get into it. Jake, we'll start off with you. Kind of what's your background, and then what is Lemonade for the average person? There'll be a lot of different parts of the thesis we go into. And also, I found out today you have over 100,000 shares of this company. So you're a little bullish on this one.
Yeah, I'm super bullish. And I would just like to make it very clear. I am bullish because of what I learned when I started researching this company. I'm not bullish because I have a big bag. Just so that you understand the logic there. I don't want to spend too much on my own background because I would like to focus on Lemonade. But I was homeschooled growing up. Did a lot of debate similar to Amit. I started my entrepreneurial journey at 14 with a Call of Duty YouTube channel, and eventually did e-commerce, got into investing. I first became successful in investing, all-inning on Tesla in 2019, and with the help of leverage with some margin, which I don't necessarily recommend. I turned $20,000 of YouTube savings into over $1 million, being all in on Tesla. Yeah. So I have not found a story that was as exciting as Tesla in 2019 since then until Lemonade towards the end of last year. And this is a story that I think is just starting, and I think it's going to be massive. In my opinion. So let's cool if I dive into some background on Lemonade. Oh, and I should just say it was actually Paperbag who he's been making content on Lemonade for as long as you've been making content on Palantir, Amit, maybe even longer. How long has it been, Paperbag? 5 years, 6 years you've been making Lemonade content?
It's 4.5 years, something like that. Yeah. 4.5.
Yeah. So he's been following it for a long time.
It's been a long
and a little bit later in this deep dive, I'm sure we'll really appreciate getting into some of his spreadsheets and numbers because he's really someone who gets into the weeds of it all. But let's start with some big strokes overview. So Lemonade is an AI company that happens to sell insurance. In a similar vein to Tesla being an AI and robotics company that happens to sell cars. This background that I have on mine, I know you're showing the stock chart right now, but the background that I have here behind me, this is literally Lemonade's ontology, like a Palantir ontology with memory banks, models, different libraries interacting with different features in the app. Lemonade is built on a single platform for the purpose of building an autonomous company. So like the pink are like some of the customer facing LLM models, and we'll get into that a little bit later. So then the first question you might have is, okay, if it's an AI company, like why did they decide to sell insurance? Like, isn't insurance super boring? Isn't it super lame? If you're going to start an AI company, like what do you do anything besides that? So that's kind of the point, actually. That's the reason why the founders of Lemonade wanted to start insurance. So there's kind of three reasons here. First, insurance is one of the industries that currently is fully automatable. Because the product that they sell is literally just a promise. There's no physical goods you have to make or anything like that. It is all just exchange of information. That is all insurance is. So it is a job or a company that every single job within can be fully automated by AI agents. And that is why it's such a great industry to try and fully automate first, the first of three. So the second reason,
and the obvious idea is there because operating margin should go much higher if it's automated.
Yeah, for sure. We'll get into their scaling laws and stuff. It's really exciting. But then the second reason they decided to launch this AI company in insurance is because insurance, most people don't know this, is literally 8% of US GDP. It is massive. It is bigger than like cars. I think it's literally bigger than oil. Like it is massive because you insure everything, right? Yeah. So across every single industry, you're insuring stuff. So globally, insurance is a $7.5 trillion total addressable market. And Lemonade right now is a $3 billion company with $1 billion of in-force premiums. So they have $1 billion of annual premiums in a $7.5 trillion annual premium market. So it is insane, the massive kind of blue ocean that Lemonade can tackle here. And then the third reason they decided to start this AI company in insurance is because insurance is ripe for innovation. It is one of those industries that hasn't been disrupted in over 100 years. There are literally many of the incumbents are over 100-year-old companies. So like they're started far before the internet. Geico famously, Ajit Jain, who runs Geico, he famously said that trying to integrate like any sort of tech thing is really difficult for them because they have over 600 systems that don't talk to each other. So it's siloed information. It's different operating systems. So some of that operating system is paper. So it's not really set up in a way where they could even train an AI with their data if they wanted to.
Right.
Long term, they are trying to get from 600 systems down to like a dozen, Ajit Jain says. But like these sorts of really, really old companies are just slow moving, and they're ripe for innovation. So those are the three reasons that they decided to get in or start with insurance.
And real quick, they sell every type of insurance, right?
Yes. Well, so Paperback can get into this. They don't have every type of insurance yet. Right now, they do renters insurance, pet insurance, life insurance, home insurance, and they are scaling car insurance at the moment. Mm-hmm. And they have been dominating stuff like pet insurance because their costs for fulfilling claims are so low because it's like already 55% instant, fully automated claims with no human in the loop. They're selling 97% of their policies with AI, no human in the loop. So they just have so much efficiency that especially low premium stuff like renters insurance, they can just offer you such lower rates because such a big percentage of the premium you're paying with incumbents includes that cost of all those employees. Like every time you call, there's big expenses connected to that.
It's almost like they're with SoFi, right? Like they don't have the legacy banking branches, physical locations cost. So theoretically, they can give you a higher APY because those costs don't exist.
Yes. Yeah.
Got it. For
For sure. Yeah, exactly. They don't need as much of it. So they can have higher margins and cheaper policies at the same time. So like a traditional insurance company, oftentimes their expense ratios, which is the percentage of the premium that is used by the company to run the company, not even including claims and payouts, the expense ratios of a lot of these companies are as high as 30%, like between 20 and 30% oftentimes. So you did Oscar last week.
Yeah.
They're trying to get down to 15% expense ratios, which would be like half of some of those incumbents using AI. But the problem with Oscar, as far as long-term margins goes, because they sell through the ACA, the lowest they are legally allowed to get their loss ratio, which is the other side of that premium payout, what you're actually paying out in claims, they're not allowed to have it under 80%. So with 15% expense ratio, 80% loss ratio, you're left with a 5% profit margin. Whereas like Lemonade already has a 73% loss ratio. So they get that same 15% expense ratio. And now their combined ratio, I know this is a little bit in the weeds for insurance. Their combined ratio is much lower. Their long-term profitability potential is much, much higher. But I'm digressing a little bit. So Third point of background here is the proven founding team. So both Shai Wininger and Daniel Schreiber, the two co-founders of Lemonade, they both come from previous billion-dollar unicorn exits. Daniel Schreiber sold his last company to SanDisk. It was mentored by the CEO of SanDisk. Shai Wininger, his last company was Fiverr. It went public, and I think it's worth over $1 billion. And it's really interesting. After their last exits, they didn't know each other. They were both thinking about what should my next company be, what has the biggest opportunity. And I'm pretty sure they both came to insurance independently, and then they were connected to each other by a mutual investor. And yeah, we can get it. I'm sure that Paperbag and Neil can get more into Daniel and Shai, but they are a very proven leadership team. And the execution that they have had has been second to none so far. It's actually been really, really impressive. They hit 1 million paying customers faster than Netflix, faster than Spotify, and faster than Amazon. They have grown 10 times faster than the actual legacy insurance companies like Allstate, Geico, State Farm. Lemonade hit 1 million paying customers in 4.25 years. It took USAA 47 years. So more than 10 times longer to hit 1 million paying customers. Obviously, these companies were started in the past where there was no internet. It was much slower to scale, to get the word out, that sort of thing. But the fact that they're even they hit the 1 million paying customers faster than Netflix, Spotify, Amazon, these are new top of the line companies. In their first 5 years, they averaged 150% compound annual growth rate, which was faster growth in their first 5 years than Meta, faster than Amazon, and faster than Apple in their first 5 years. So these are very experienced co-founders that are here to take the whole industry. That's kind of the point that I wanted to get across with this one. We can talk about them a bit more if we want later. Fourth, so this is more specific to insurance. But Lemonade is rethinking the trust dynamic in insurance, which is very important. So if you think about right now, the relationship between the insurer and the insured is very it lacks a lot of trust. Let's just put it that way, because the insured knows any dollar that the insurance company doesn't pay me, they keep its profit. So obviously the insurance company wants to not pay out as much as possible. So they want to pay claims as slowly as possible, find whatever reason they can to reduce the payout. And there's really no trust there. Insurance fraud is a big issue because no one trusts each other. So Lemonade was like, how do we rethink this from a fundamental level? And they created the Give Back program. So when you sign up for insurance on Lemonade, you choose a charity, and that puts you in a cohort of everyone else who's with Lemonade who chose that same charity. If a cohort's loss ratio is under 40%, all of the unpaid claims get under that 40% get sent to the charity of that cohort that cohort chose. So it changes the trust dynamic, because every dollar Lemonade doesn't pay me, they're not keeping themselves. They put a cap on their own profitability. Now, 40% would be a very incredible loss ratio, right? That no other insurer has ever dreamed of. But they have actually already paid out millions of dollars to charities, because different cohorts, there's less incentive to file a fraudulent claim if you know that it's going to go to charity if I don't claim this myself. Right. It changes the whole trust dynamic, turns it on its head. I think it could actually be a bigger innovation in insurance than the AI side, which is insane, because AI is obviously going to change everything and is, I think, bigger than the Industrial Revolution, bigger than the internet. So this is a really cool innovation as well. And this is getting a little bit into the clouds, a little bit too long term. But when AI is actually running this, it kind of puts a protection to customers if Lemonade takes the whole market, that the AI is not eventually just going to take the whole market and then keep on raising the premiums until it's disgusting.
So let's get Paperback in this as well. Based on everything you heard so far, I guess the question to you, and I know you've been making content the longest on this name, is what attracted you to Lemonade? Is it kind of what Jake was talking about, or is there something else to this thesis that really sold you on the name?
Oh, it's exactly what Jake was talking about. And just to touch on my background, I'm from an engineering background, manufacturing engineering background. I'm part of a family business and running that and operating that now. And so I get I get excited about, how can we streamline processes? How can we make it better for all parties, for ourselves and for the customer? How can we make any sort of system process better, more efficient, smoother? In any sort of business setting. And so, yeah, Lemonade attracted to me because I thought, man, insurance, there's so much, like, even like a decent insurance company, there's so much slowness and bureaucracy and like weird forms or like processes as a customer you fill out. Um, and so Lemonade's, it was that sort of digital first structure that really attracted me. And yeah, all the, there's so many benefits that when you really do that well, I think there's so many benefits that derive from that. And an interesting little anecdote about Shy, who was one of the co-founders who started Fiverr, is I know when he started Fiverr, they grew really rapidly, really fast, and they lost, like, in his sort of mind, they lost some of the magic of like the startup when they're sort of in startup phase, or these small, super efficient, like hyper efficient little groups of engineers working, making this product better, where all these, and then they scaled and they just had to get more and more and more people, and they lost sort of some of the culture and magic of what it was like when it was still in startup mode. So now he takes that experience and he's starting Lemonade, and I think that really shaped how they thought about this company from day one. Really thinking really thoughtfully, like, how can we put AI, really build this now, years ago when they first started the company, even before they're public, so that we can build upon this foundation and plug in the latest, greatest AI models, in the most sort of in-depth way possible, right?
Yeah, it is important to note that Lemonade was started as an AI company in 2015, before ChatGPT. It's not one of these like late comers here. Sorry, keep going, Paperback.
No, totally. Yeah, that's awesome. Yeah, so that was ultimately, to me, I thought, there's so much potential if you make an insurance company like that and you don't have all the baggage that a legacy company would have. There's more upfront costs, of course, because you're investing more to build out those systems, to hire great engineers, that more engineers than you need if you just, went sort of a more traditional route that was, you had less of that kind of system built in, or that thought for that system. But I think that, that investment that they made and will make is going to pay huge dividends. As they scale, we're just going to see. We've seen, tremendous operating leverage over the last, whatever, I think it's like a couple years. The IFP, or in-force premium, what's the premiums on the book, went from like 600 million to $1 billion, where all their operating costs, outside of what they're spending on marketing, outside of that spend, the rest of that stayed flat. And I think we'll continue to see that, like a very slight increase in those other costs while the top line grows. Just as they're able to, continue to scale. So, yeah, that's what got me excited. I was just like efficient, smooth processes, systems, and thinking about that.
So let me get to Neil, and then we'll get deeper into some questions. Neil, what got you into this name?
Yeah, so just a bit of background. I did about 20 years in financial markets, investment banking, and the system infrastructure is very sort of similar to insurance companies. And I've always had a sort of like entrepreneurial spirit. I'd taken some time off work to consider whether or not I could build a similar system for investment banking and those sort of clients, like something that was unified across the infrastructure stack. And I've always been an investor in parallel, taking sort of like high conviction bets. My first one was Apple for about a decade. The second was Tesla, similar to Jake and Paper Bag. And then I actually came across Lemonade through an interview that he had done with one of the OG Tesla investors, Dave Lee. And it was, what drew me really to them was Daniel Schreiber. His sort of like clarity of thought, the consistency of messaging, the way he was able to communicate what their North Star for their business was, I think that was a huge draw for me. And I sort of, just as I had done with Apple and with Tesla, you sort of go down rabbit holes like studying the leadership of the company, right? You try to watch every interview they've ever done. And I did the same thing with Daniel. And I was like, wow, this guy is really, really impressive. And, kind of understanding the North Star that they were going for and sort of understanding that this is something that I would have loved to have tried to do in the sort of investment banking space, I sort of knew that they were onto something pretty big. So I think that's really what sort of drew me to them, and has kept me sort of studying and analyzing their business. And that's pretty much what I've been doing like full time for the last 2 to 3 years. I think I've clocked about 10,000 hours just trying to get to know the company. It's not just getting to know the company and getting to know the leadership, but it's also studying almost like in a way where you're manually data scraping the internet every single day, trying to find every single thought, every single opinion, every single view on the company, and try to understand like why do these people think this about Lemonade? What's sort of underpinning a lot of these arguments? How do we sort of deconstruct and dissect them and sort of put it all back together to come up with a thesis? And I think the more time I spent on the company, the more I was like really drawn to it. And then for me, I had like probably about a 60% confidence rate in the company that they would be successful. I first got interested in the stock around the time of the IPO. I did sell out around 100, and then I sort of moved on to other investments. And I noticed that the stock had dropped to about 30, and I wasn't exactly sure why. That's when I got interested in the company again, and it was around 30 at the time, and the stock went all the way down to $10. And that's when I was like, wow, what's really going on here? I don't really understand why the sort of the view of the market is so negative on this company. And I think that's when I really started covering the company on Twitter, like publicly, just a couple of years ago. And I started to catch attention from the company itself. Some of the people started liking my tweets, retweeting it. And then that's when I sort of just decided to reach out to Daniel and say, hey, can I get a couple hours to sit down with you? I've had a ton of questions. I feel like there's this pervasive misunderstanding about the company. And that's when I sat down with him. And I would say, my confidence in this company's ability to execute on their vision went from about 60% to about 80 to 90% after I spoke with Daniel directly. And I would say like the only reason I was able to, I think, make that 2 hours with him so effective was because of, the 20 years of experience that I've got in this actual industry where, it's and sort of trying to understand the concerns of the market, bringing them up to him, and then having him directly address so many of those. I think that shot my conviction through the roof. And then I just continued to study the company. I had a chance to sit down with Shai Wininger as well. Got to spend an hour and a half with him. And I think now, if you talk about sort of like confidence in the company, I know like most people don't like to say this, but I don't really care. I think my conviction in this company is in the upper 90s that they're going to execute on their vision and they're going to become what they say they're going to become. And I think that, I'm like Jake said, I'm interested in many other stocks, but I don't think I've ever seen an opportunity in the market as mispriced and as misunderstood as Lemonade is right now.
Okay, so let's transition to that part of the discussion. And Neil, I want to kick it off with you, and then we'll get back to Jake. I think everyone's wondering right now, why exactly is Lemonade asymmetric? I mean, they could invest in NVIDIA, obviously Tesla. There's so many amazing companies. So what is it about this one, outside of just the general thesis, that truly makes it mispriced?
So I think it comes down to the lens that a lot of investors look at the company with. If you look at, they're an insurance company, right? And insurance is a very boring industry. And when you look at insurance companies, you typically look at their book value and you say, what's the multiple of the valuation against their book value, which is, like equity net of liabilities. And that's always the typical valuation metric that an insurance company gets. But Lemonade is not a typical insurance company. They're a software company doing insurance. They're a technology company doing insurance. And so what you really got to look at are a sort of completely different set of metrics. And I think what happens is a lot of people just sort of look at the surface level metrics. They don't really see what the company's stated ambitions are, what it is that they're trying to do. They don't really understand the financial structures that they've put in place to gain leverage across reinsurance and the synthetic agent program. And they've also never seen an insurance company scale up sales and marketing expenses to acquire customers and then not see an almost linear relationship in the actual underlying operating expenses. So as you sort of start to scale your sales and marketing expenses and you bring on new customers, you also then see a sort of linear relationship with the underlying operating costs because you need more employees to service those customers. And so that's the one thing that Lemonade is breaking the model of, where you can continue scaling up with customers, taking on more policies, more premiums, but you don't need to change the underlying operating expense structure. And I think that's like one of the key misunderstandings that a lot of the market has. And when you have this sort of like huge misunderstanding about the company, because most investors, like the stock has about 30% short interest. I think it's somewhere in that range, 17 million shares. And I've spoken to almost every single one of these funds. Their analysts have been on Twitter at times, and they've laid out their bearish thesis and why. And they're looking at very static insurance filings. They're looking at very static sort of like data that's always backward looking. They're not looking at things that are forward looking. They're not looking at the trends. They're not looking at where the business is going. They're looking at where the business is. And I think that's what makes it so asymmetric. It gives it so much upside because when this sort of like, it's almost like there's this narrative lag where people don't really understand what the company is. And, I think those of us that have spent the time to study the company, you kind of can see where it's going. And I think what's going to happen over the next 12 months is you're going to see the numbers match up to the narrative. And then I think at that point, once that happens, we're going to see a major break, major repricing of this company to the upside. And that's why, I'm pretty much all in right now. I've still got some, shares of Tesla, but that's more for like nostalgia reasons. So yeah, I mean, I think
what exactly is that narrative that you think the market needs to? Is it the whole? It's a tech company, not an insurance company.
Well,
yeah, I think it's exactly that.
Well, yeah.
Yeah, somebody else
Yes.
wants to jump in. Go ahead. Yeah, Jake, go ahead.
Neil, you're doing an amazing job, by the way. I'm looking forward to listening to you more, but I just wanted to show up, like, kind of throw out some of the actual valuation multiples right now to kind of give us a baseline to understand like where we're talking from here. So right now, Lemonade is kind of valued as a slightly expensive insurance company. It's trading 3 times in-force premium. Where a lot of insurance companies like that are big, slow, not growing at all, will trade like 1-2 times IFP. So Lemonade trading at 3 times IFP, it's not actually even that expensive for an insurance company when you consider its compound annual growth rate, which management is saying is going to be 30% for this next 10x from 1 billion to 10 billion. The average growth rate will be 30%, and I think that's conservative personally. Once they really start printing cash here. So they just hit free cash flow positivity. And if you do a look through PE on Lemonade, so you look at, okay, they're going to do about 1.2 billion in premiums in 2025. Let's assume that they'll have a 15% long-term profit margin on that, which once again, I think is quite conservative. It's trading at 17 times look through PE. It's trading 17 times look through PE while growing 30% a year. Peter Lynch, he's one of my mentors. He was one of the best growth investors. He managed Magellan for Fidelity Magellan, averaged 29% average compound annual growth rate. His rule of thumb is if you can buy a growth company for an equal PE of their growth rate, it's fairly priced. So if a company's growing 40% a year, buying it for a 40 PE, Peter Lynch would say is a good price. If you can buy it for twice as much as the growth rate, so if it's an 80 PE growing 40%, it's very expensive. And then if it's a 20 PE growing at 40%, it's very cheap for a growth company, especially if they can maintain that growth rate. So Lemonade can definitely maintain their 30% growth rate, in my opinion. And they've been accelerating growth, by the way, for the last 7 quarters in a row. Every single quarter has been faster growth than the quarter before that. Management guidance is that is going to continue. They're just under 30% growth this year. They'll be north of 30% next year. And it's trading at 17 look through PE. So it's just very cheap as far as any look at a growth company. And then
Neil,
my discounted free cash flow.
Yeah, so I was just going to say, just to sort of go back to your question, Amit. This is sort of just to keep it very simple, right? I'm sure you've heard this old saying, history doesn't repeat itself, but it often rhymes. And I think this is just another classic example of a company that's approaching an already existing industry that's totally misunderstood. I mean, you can go back to so many different examples like Amazon, like Tesla, like Netflix, and so many Spotify, that have been covered by analysts that come from entrenched spaces that don't really understand when somebody brings a completely different business model to that industry. And they have difficulty sort of bringing a new lens, a fresh lens to looking at the company and kind of understanding the dynamics of how it's playing out and how they're going to achieve the sort of success that they've set out to.
I could add too, I think part of the misunderstanding is that they're making a lot of people look at the financials and say, look, they're sometimes I think that's why people discredit them. They say, look, are they ever going to reach profitability? When will they reach profitability? What's going on here? Like, when will they get their act together, kind of? But I think they have been, and they continue to make a lot of investments that are more upfront investments where you're bearing all the costs right now, and then you're going to bear all the fruits, later on. So that's like I mentioned earlier, they're spending more money on engineering, more money on tech development as they develop the system or have developed the system. They're expanding geographically. They're not just like, hey, we're car insurance in this part of the US. They're like, no, we're actually in Europe. We're in the United States and all these different products. When I asked Daniel in my first interview with him if what they'd be in Canada one day where I am, he's like, you could really ask me that question about any country in the world and just about anywhere we hope to be eventually. So they're expanding. There's more costs, regulatory costs, that kind of thing, as you're expanding and pushing that out than if you just concentrated on one little niche spot. And then, they have less of it. You're starting a new insurance company who have all these different products. You have less of you'd have a data disadvantage as you start with, where you're still learning and figuring. They've made tremendous strides in that area, but you start off with no data, right? And so you're snowballing that data over time. And then a big, huge one is they spend most of their sales, most of their customers they acquire are direct, where they're spending, on advertising to go direct to your customer. And this is versus a lot of legacy companies where you outsource that and you say, hey, we have a team of sales agents. You guys, hey, help us out. You go get us customers. And then we don't directly pay you, but you can take a stream of the premiums from that customer for the lifetime of that customer. So that model, you don't have that upfront cost, but then you get hurt on that cost down the road, going forward for the rest of the life of the customer. They might take 15% of the premiums. Well, Lemonade says, yeah, we'll just pay the cost right now. The market won't get it. It's going to hurt our financials right now, but we're going to reap all the rewards after for the rest of the life of the customer. So that's a huge one, especially as they ramped up how they're, that when background over the last few years, COVID hit, inflation went crazy, it really hurt insurers. Loss ratio just meaning the amount of your premiums that you're paying out in claims. Those went way up because things got more expensive. And then it takes time for regulators to approve your pricing as an insurance company, so you can adjust your pricing, so then you can fix your loss ratios. So that whole cycle took some time, but they're just say all that to say they have so much upfront costs in all these different areas, and they're paying dividends now. We're starting
to start reaping the rewards.
We're starting to see the fruits of that, and we're only going to, continue to see more of that. So I think that's a big part of the misunderstanding is people don't understand sort of the investments they're making right now and how they'll work.
Yeah, Jake, you can continue also with some of the other valuation stuff you're talking about.
Yeah. So based off of my discounted free cash flow model, which is just looking at management's guidance and then being a little bit conservative to that, despite the fact that management has actually hit or beat guidance for 19 quarters in a row, I'm still being conservative on my discounted free cash flow model and assuming that they grow a little bit slower than they say they're going to grow. And I discount it back 15% a year from 2035, so from 10 years out. The current present value of Lemonade's future free cash flow is $190, and it's trading at 40. Like we've seen a period of 5 years now where the stock has gone from $180 at its peak to $40. So it's discounted 75% now from where it was just a handful of years ago, and the number of customers has tripled. The amount of in-force premium has more than quadrupled. So you have this. Can I share my screen actually and show some of this? Let me see.
If you press present in the bottom, then share screen, you should be able to do that. There you go.
Can you guys see that?
Yep.
Okay. So this is total Lemonade customers from 2018 Q1 to now Q1 of 2025, which was the last quarter. So in 2021, back here, we were trading at $180 a share with about 1 million customers. Now we're at, 2.5 million customers, and we're trading at $40 a share. That's just one point. If you look at premium per customer, that's been increasing because one of Lemonade's strategy is let's go after the customers Legacy doesn't care about that are very cheap, like pet and renters. Lemonade's average customers under 35 years old. Lemonade is actually the most loved insurance brand in the world for those under 35. They're saying, let's acquire them cheap. Then as they grow up, they buy a car, they buy a house, we add new insurance. And this is why you see the insurance per customer just growing, the premium per customer just growing over time. So then that leads to an effect where the actual in-force premium is growing faster than customer count, right? Because they're adding customers and growing the amount that each customer is paying. So, back in 2021, the total in-force premium was about, 300 million. And now we just passed 1 billion. And like I said, the stock is 75% discounted from there. This is their trailing 12-month gross loss ratio. So this is the amount of premiums that they're collecting that they have to pay out in claims. And because they have an AI training flywheel where billions of data points are literally making their AI models better at underwriting and stuff over time, the AI just gets better and better at pricing. Lemonade gets better and better at pricing premiums. And we've seen this just drop. We're at 73% in Q1 of 2025, 73% loss ratios, which is exactly where Lemonade was guiding that they were trying to get to.
So in your DCF, what is the 10-year CAGR, and then what's the operating margin in that 10 years as well?
So it's expecting a 15% net margin on. It's a CAGR of about 28%, whereas management's guiding for 30.
Right.
And then the PE that I'm expecting in 10 years is 30. And then in 20 years out, I have it going down to 20 PE. But if you discount from the 20-year out DCF, it's insane. Like the current present value is just insane. It's like not even worth bringing up because it makes me seem less reputable because it's just such a high price target.
I think, sorry, just to jump in here. I think this is one of the key things about Lemonade as well, right? Where there is such pervasive disbelief about what Lemonade is doing and what they're trying to achieve that a lot of people haven't taken the time to actually sit down, build a discounted cash flow model themselves, look forward in the future, even using the company's own guidance and even using some fairly conservative parameters. You can build that DCF model yourself, and you'll see that the company today is worth a hell of a lot more than it's valued at right now. And again, I think one of the reasons why a lot of people don't build these DCF models is because of this pervasive disbelief that there is around the company. I think as the company continues to execute and these numbers become more and more real, I think more and more people are going to be building these models themselves and being like, hey, wait a minute, this thing is like really undervalued. I think for me, there was a long extended period where I kept looking at the stock. I remember with PB, the stock was trading between like around $10. And we were talking to each other like, are we both seeing the same thing here? Like, are we missing something? We must be missing something, right? We kept talking to each other about what we might be missing. But, the longer we looked, the more we're like, no, I don't think we're missing anything. And then you sort of talk to a lot of the people who are skeptical about the company. You listen to the opinions that they have about it and why they have those opinions. And you really start to understand why there's such an asymmetric opportunity with this, right? Because again, I think it's a matter of time before a huge horde of people start building these DCF models and seeing this company for what it really is. And I think when that happens, you're going to see this. Well, I think the market technicals are such that it's set up where you're going to get a pretty violent re-rating, which is what we saw in November when it like nearly tripled from, I think it was like $16 or $17 to 50. And I expect the same sort of thing to happen at some point over the next 2 years, because I think as they get closer and closer to net income, having a profitability, full year profitability, I think that's when it's going to be undeniable. And I think that's when people are going to feel a lot more comfortable sort of building these models. But again, I think this is one of those things that it's a matter of time. It's a matter of eyeballs. You're literally betting against time and math that they're going to do what they're going to, what they set out to do.
Yeah. And I think it's impossible to know when it's going to happen. That's like why I own shares, even though I'm so bullish. I don't buy options. I think it's like it's hard enough to figure out what is going to happen. To also add the dynamic of when it's going to happen, I think just makes being an investor that much harder. Whereas just owning the shares is like time is your friend. But Paperbag was just talking about this. This is the business's top line here. In pink, this is in-force premiums. This, unfortunately, this chart ends in Q3 2024, but this has continued. In-force premium is now over 1 billion, and operating expenses, X marketing, are still flat. Two quarters later. So the question that we should be asking is like, how is this possible? So would you mind, Amit, if I show like a short 30 seconds like a video of the ontology here?
100%.
Okay, let me stop this screen share and then I'll start another one on a different.
And thank you everybody for joining tonight. We will discuss some more Bearcases and other things that are associated with this name. Everyone's Twitters are in the description, so you can follow them there. I think the Lemonade group on Twitter is like 3,000 people, so there is a pretty deep community covering this stock as well.
Yeah. Okay. So I'm just gonna play this for a second and just read this tweet that I published yesterday. So imagine if Palantir created their own automated insurance company to capture the $7 trillion insurance market. That company would be Lemonade. They are building an infinitely scalable autonomous organization run by AI agents. The agents interact with customers, data libraries, complex models, other AI agents, etc., all within a beautifully complex ontology. This AI brain and the neurons within is improving daily based on billions of data points across all domains within Lemonade, across all of its policies, all the interactions, all the different data points. As the data training flywheel progresses, which just so you know what that data training flywheel is, as they get more customers, you get more data points, which trains Lemonade's AI faster, which makes Lemonade cheaper, more efficient, which adds more customers, which gets more data points, which trades Lemonade's AI faster. So you get this flywheel effect where eventually Lemonade's AI will reach escape velocity, in my opinion, and no one will be able to compete at that point, considering that like Lemonade has no competitors doing AI in insurance currently. So as the data training flywheel progresses, the moat between the skill of Lemonade's insurance superintelligence and the non-existent competition only grows. Base models like ChatGPT from OpenAI can be used within Lemonade's own ontology to complete small tasks. And OpenAI has actually released videos with Lemonade in partnership with Lemonade in the past, talking about how they built Lemonade's natural language chat AI, which it's not useless. Like it's not one that you hate because it has this ontology. It can see everything. It can actually make changes for you. It's actually useful, helpful. You don't need a human in the loop. And so within the ontology, you can use stuff like ChatGPT. But ChatGPT can't.
To push back real quick, Jake, why is this unique to Lemonade? Why can't a lot of these other legacy companies eventually embrace AI?
So they will implement AI on the margins and for some stuff. But when you have like Geico, 600 siloed systems that can't talk to each other, you can't even use your data to train AI. Like, yeah, you can try to automate one part or another part, but building a full AI brain that eventually can run fully autonomously, it's like legacy has too much debt, too much lack of culture debt on top of tech debt. Ajit Jain recently at the last Berkshire Hathaway meeting was asked about AI, and he said that they have not yet made any large-scale effort towards AI. He says we are staying in a state of readiness towards AI. He's like, we don't want to spend money on this thing until we know that there's a clear advantage to it. So it's just the story repeats over and over. I don't know if Paperbag and Neil want to help respond.
So I think if you try to consider what are the key advantages that Lemonade has, it's sort of a combination of two that I think are going to be very hard to replicate from like a traditional insurer, just because there's so much like momentum, right? They're like these large ships that are, carrying down the water. It's really hard to sort of turn that ship around. We all know that large companies are not very agile, right? So if you think about Lemonade, that was sort of constructed from the ground up, first principles approach, et cetera, et cetera. they really have two big advantages. The first of which is kind of simple to understand, which is the business model itself, where if you think of a traditional insurance insurer relationship, you have a bilateral sort of arrangement, right? Where if I'm the insurer, if I pay out your claim, I lose. If I don't pay out your claim and I keep the money, I win. So that bilateral relationship is, I think, inherently a problem, right? And so what Lemonade has done is they've introduced this sort of trilateral relationship where they've introduced the sort of give back model, this charitable giving. So any excess is given to charity so it doesn't create this conflict of interest between the insurer, Lemonade, and the person being insured. So I think that's one key thing that legacy players are going to have a hard time, dealing with, because you just have this sort of conflict of interest inherent in the relationship at all times. The second piece, which is what Jake was talking to, and like you look at the sort of background that he has up on his screen, it all comes down to technical infrastructure, right? So when you've got an entire vertically integrated infrastructure stack built from the ground up, all in-house proprietary technology, and you construct it with LLMs in mind, which is what they've done, there's just so much more you can do with that infrastructure. And that comes down to, like, if you think about the life cycle of an insurance policy, from the point that you acquire that customer to the point that they submit all their information, to even in the back end of the business that's supporting that policy claim, you think about what they're doing, and then you think about all the way through to the payout of any claim, right? That's sort of like the full life cycle. Every single one of those pieces is connected to the same infrastructure stack. And when you can collect that data, all of that data, they collect basically, I think the last time I checked, it was 1,700 data points. If you can sort of like look at all those data points with a sort of like machine learning lens, there's so much information that you can extract from that you'd never be able to extract from a traditional insurance lifecycle. You've got agents, you've got disparate systems, all these sorts of things. So I think it's going to be really, really difficult.
You think it's going to be very, basically what you're about to say. You think it's going to be almost impossible for the legacy insurers to adopt that integrated of a model for AI.
I wouldn't say impossible, but it's going to be very difficult, right? I mean, history is our guide. We can look at so many different industries that have been disrupted by a small player. You look at, the innovator's dilemma. How do you overcome the technical debt? Because you have to continue paying for your systems as is now. And then at the same time, you got to try and bring that entire infrastructure stack onto a completely new system. I mean, these things are very, very hard to pull off. And I've got, direct working experience having done a lot of this stuff. So that's, and I mean, technical debt is one thing. Jake said this as well before. There's also cultural debt, right? When you've got these largest companies with all this waste, I've worked inside these organizations for a long time. There is a real cultural debt that you have to overcome. I like to consider it like corporate rot. You just get caught up in governance and committees. People have fiefdoms. Nobody wants to change. This guy's probably close to retirement. He doesn't want to rock the boat. These sorts of things happen all the time, right? And it's really, really difficult to overcome those challenges. You're essentially asking insurers to totally disrupt themselves from the inside out. You have to build like a completely siloed team to build the entire business from scratch. And I think that's just something that a lot of these companies aren't going to be able to do. And I think it's also going to be very difficult to attract the talent to pull something like that off. So I think that they lack the will. They just lack a lot of things to be able to try and to catch up. So I think, Lemonade, and Jake alluded, you said this in your podcast before. It goes back to my interview with Daniel. When Lemonade did their IPO and they raised a lot of cash, there were only a few insurtech startups. Then the whole industry faced a bunch of challenges. So all the funding dried up for a lot of these companies. But Lemonade kept just working, kept building. And I think at this point, they've probably got at least, say, about a 4 to 5 year lead for anyone to do what they've done. Because not only do you need to build the infrastructure, you need to gather the data, and then you need to sort of like stack everything upon itself and continue building upwards. And I think that's just going to be a massive uphill struggle for anyone to do right now.
I don't care if you have the smartest Palantir engineers working for you 24/7. Legacy insurance companies are never going to be willing to pay claims instantly. That it's just opposed to everything they believe in. The longer they wait, the more they can, try to nickel and dime away that amount that they're paying you. I mean, even Tesla insurance, they literally have the car telematics. They see when you get into an accident. They have the camera footage. And if you file a claim, I had Tesla insurance. I recently switched to Lemonade. They don't even pay out the claims instantly. Like their AI, if you call into Tesla insurance, their bot is so stupid compared to my when you call into Lemonade. So even Tesla, who I love, I'm a fanboy of, like I'm the biggest Tesla fanboy. I'm wearing a Cybertruck shirt. It's like they are not even going to be able to compete against Lemonade in insurance. So how are 100-year-old companies that as Neil described aren't even going to want to do this stuff because it opposes their business model?
Is the paying of the claims within seconds a detriment, you think, to the overall sustainability of the business?
If it would be if it meant that they couldn't do as good of a job with fraud detection. But with AI, which can scan all the documents, pre-existing conditions, it's literally like AI Jim is dealing with every single claim. So it can spot, like it's going to be better at fraud detection than a human. It's just going to have so much more experience. It's going to have dealt with so many more claims. So I think it's not a detriment as long as AI Jim continues to get better and better at actually detecting fraud, and it is.
Yeah, and it shows up in their. I haven't heard them publish it as recently, but I've heard in the past Net Promoter Score is something like 70 or 70s versus, I don't know, insurance average. I know it's way lower, probably closer to 0.
Right.
So
okay, so let's get into some bear cases, because I think to summarize so far, the bull case is PE on a 10-year basis already is discounted half of their compounded annual growth rate. AI is the tailwind that they have built intrinsically into the company versus it being just like a bolt-on for the way they process and ultimately underwrite claims. And growth is significantly higher than the rest of the members in the industry. And as a result, the rate or the premium that one would give to a company that is growing that much in an industry that really doesn't get a high premium should be greater, just simply because it has much more growth. Jake, we'll start with you. What do you think is I want all three of you to give me one bear case. So Jake, if you had to pick one, what is your biggest bear case?
So funny enough, this is not something that the shorts would actually talk about, but I think it's my personal biggest fear. And it is that legacy, because they can't compete based off of merit, will try and regulate Lemonade away. So insurance is a highly regulated industry. Now, thankfully, Lemonade does have quite a bit of regulatory like diversity, because like every single state in the US regulates insurance independently. So that's really good. Even if one regulator were to say something about like you can't use AI for this because it's racist or something, that would only affect one jurisdiction. They're also international, right? So they're in multiple countries. But I actually think the best weapon that Legacy has is lobbying while they still have more money to try and slow down the pace of AI, because I don't think they're actually going to be able to compete based on merit. I really don't.
Okay, Neil, what do you think is your biggest bear case?
Well, so the one I hear very often is that this so they have this financing arrangement for funding their growth. And a lot of people talk about, it's called synthetic agents. It's just a marketing term, frankly, right? That they use on this, what is essentially like kind of like a credit line. It's it's just a facility for them to draw on to pay for customer growth. A lot of people call this like a desperate play for, keeping up customer growth. They look at the numbers and they say, oh my God, you're paying a 16% IRR. This is pure desperation. And all you retail shareholders are just lapping it up, right? But what I think that a lot of the bears fail to understand is the fact that 16% is actually self-funding, right? So the company has reached product market fit. They can do profitable growth. That 16% can be covered from the customers that they're onboarding, and it later then drops off and they get to keep that relationship entirely. So I think this is just one of those things that's really, really misunderstood by the market, how it works. People look at it as like a traditional debt instrument at a 16% IRR. And that headline for them is that this is a terrible arrangement and it reeks of desperation. I think that's probably one of the most misunderstood points about the company.
So can I dive into this a bit more? So what limit? So Neil is right. This is the most commonly brought up argument against Lemonade. But what the shorts don't understand is that the synthetic agents who are funded by General Catalyst, which is a venture capital firm, all of the money for the synthetic agent spend is put up by General Catalyst, and the synthetic agents themselves bear the downside risk of this spend, not Lemonade. So the synthetic agents, they work similar to a traditional insurance agent, which receives a percentage of the annual premiums. The synthetic agents only get paid if the customer cohorts that they fund are retained long enough to repay them. So just like a traditional insurance agent, only continues getting paid if their customer stays, that's the same thing with the synthetic agent. So the difference, though, the really exciting difference is once they're repaid with interest, the synthetic agent falls off and Lemonade retains all of the customer upside without the perpetual agent fee. So they're paying a 16% fee only until the debt is paid back and the synthetic agent falls off. But if that customer cohort turns away too fast, Lemonade doesn't have to pay back what the synthetic agent spent to acquire the customer for Lemonade. That is the really big thing. So Lemonade is forced, however, to include the synthetic agent spending on their own debt. So they have to include it on their balance sheet. But they're not allowed to include the customer's lifetime value, which the debt is actually like valued against. So if the customer's lifetime value, which they're adding with every new customer that they acquire, if they were able to put that on the balance sheet, then Lemonade's book value would already be growing. But they have to put the synthetic agent debt, the synthetic agent spend on their balance sheet as debt when the synthetic agent is the liable party if the customer stops paying. So this is not actually debt that could like hurt Lemonade shareholders. And what the debt is backed by cannot be added by Lemonade onto their book, which is the customer lifetime value. So it's a little bit of this interesting situation right now, where if you look at Lemonade's actual free cash flow, like if you take that 80% of growth spend that the synthetic agents are currently paying that Lemonade's not paying, and you back that out, because that doesn't actually affect Lemonade's free cash flow. Lemonade's already free cash flow positive, which is why I think there's very little risk. Does that make sense? I'm not sure if that explanation was clear.
I think it's a fundamental dichotomy that's different between them versus the legacy insurance companies. The way I'm really understanding this thesis, if I had to sum it up for dummies here, is just like, it's really reminding me of SoFi. SoFi does not have to deal with a lot of the legacy costs. A lot of people say, well, SoFi doesn't have a moat. They're just a bank. Like, why is that big of a deal? Their price to book ratio is already double of JP Morgan. Why do they need some huge price to sales, price to book, like a typical tech company? The SoFi bulls will say, well, they're growing better than a JP Morgan or a Bank of America. SoFi is growing 30%, Bank of America is growing 5% because of the technology, because of all these nuanced elements to their business that they don't have to deal with that Bank of America does. That's essentially what I'm getting in a variety of different things you're describing that Lemonade has as an advantage. I guess the broader question for the market is that enough for us to care about this company over a UNH that does $22 billion in free cash flow?
Yeah, and I'm saying it doesn't matter, because the next doubling of in-force premium 20x is free cash flow. So who cares if the market gets it now? Like, the fundamentals are going to show it in a year. So I'm on this podcast to try and help people out, because like Lemonade is going to be fine whether or not the market figures it out now or after free cash flow 20x's.
Yeah, I think that's just another thing around. There's a lot of funds out there that have mandates that don't allow them to invest in not profitable companies.
Yeah.
And they sort of look at the headline figures for Lemonade. They see that it's not a profitable company. Like I said before, right, they'll just look at some, static insurance filings, and they'll say, actually, so this actually goes on to another, I think, potent bear case that a lot of people make, which is they look at the company, they look at the metrics, and there's this metric that people look at for insurance companies. It's called combined ratio. And combined ratio for insurance companies is essentially your expense ratio and then your loss ratio. So for every dollar you take in, how much are you essentially paying out, right? If you look at Lemonade on paper right now, that combined ratio is above 1, meaning they're paying out more than they're taking in. But I think what a lot of people, again, don't really understand is the dynamics of this, right? That expense ratio will continue to become smaller and smaller. And what we're also seeing in the trends of the company is that loss ratio that they're paying out for every dollar in claims is also coming down. Last quarter, it was, if you strip out some of the catastrophic events, it was actually 59%. So sub 60% for the first time, I believe, in the company's history. And I think this was a huge milestone for me. When I saw it, I was like, wow, this company used to have loss ratios in the 90s, and that would put their combined ratio like well north of 100, meaning they're totally not profitable. They're structurally unprofitable. But really what we're seeing now is that loss ratio has come down a lot, And as the company continues to grow, that expense ratio will become a smaller and smaller part of their overall combined ratio. And I think what we're going to see over time is that that combined ratio will eventually get under that one mark that those traditional insurance analysts want to see it as. But it's not going to happen until the company sort of matures and gets to scale. And I think so. I want to sort of go back to something else, right? I had a conversation with Shai Wininger. One of my key takeaways from that conversation was that they built this platform to support 10 million customers, and they're only supporting about 2.5 million right now. So if you look at that cost structure that they've got at the moment, that cost structure is there for 10 million customers. So we're not going to see a very material change. Maybe it'll tick up somewhat, but we're not going to see the sort of same linear relationship between costs that you traditionally see with legacy insurers versus that of Lemonade. And that's simply because they brought this sort of software approach to the whole thing.
Yeah, and this is not just like words. So if you look at this, this is Lemonade's past. So this is 2021 to now. You can see in 2021 that bottom line, this heads. In 2021, they had 1,119 employees. Now they have 1,216 employees. So while they grew top line 25% annually from 380 million to now over $1 billion, this is from the 2024 Investor Day. So it's from last year. Headcount has barely been increasing at all while they've been growing revenue. And like Neil just said, like they've been building a platform to support 10 million customers, which is why Shai recently said in an interview with an Israeli newspaper that they can add 1 million customers, another 1 million customers. They already added 1 million customers without increasing headcount. He said they can add another 1 million customers without increasing headcount. Like that is unheard of in insurance. Like this is not a normal insurance company. That's never been done before in this industry.
And if someone asks what's the catch, your argument would be, I would assume, A, they have to forgo profits in the short term. So the catch is they don't get to be profitable. And B, the other catch right here is that the other legacy companies simply don't understand AI. And that is the explanation here for why Lemonade can grow this fast.
Yeah. And I mean, AI hasn't been around that long, right? So there hasn't been that much time, for other insurance companies to even attempt this. But we've been talking. So can you show the screen one more time here? Yes, they're not GAAP profitable yet, but the guidance has not changed since 2022. The 2022 Investor Day, and by the way, I was not an investor back in 2022. I was still very skeptical. They made some insane guidance that they were going to become GAAP profitable by 2027. Like, how do you say that in 2022 that they were going to be EBITDA profitable in 2026 next year? But then 2 years later, the 2024 Investor Day, they met and beat every single guidance expectation that they laid out in 2022. And the guidance is still unchanged. And they actually hit free cash flow positivity a year before they were guiding. They guided they were going to become cash flow positive in 2025, which is this year, EBITDA profitable in 2026, which is next year, GAAP profitable in 2027. And they hit free cash flow positivity last year in 2024. So a year early. And like I said, this next doubling of in-force premium, this next doubling of top line is going to be 20xing free cash flow because of these scaling laws that we've been talking about, the fact that they're automating every single job. I mean, just one way to think about the dynamics of the company, like who's actually behind this company is very different from a traditional insurance company. Normally you have actuaries, underwriters, agents that are all human. In Lemonade, it's like it's like 30% paper bag, or is it more than that? Engineers, like AI engineers. Traditional insurance companies buy their software third party. None of them actually like make any software themselves. They have no engineers. So it's just like I said, it's an AI company. It's not, even though it sells insurance.
Paper, we didn't get to you. What is your big bear case on Lemonade?
Another one, and this kind of moves the topic a little bit, but something I commonly hear is people say full self-driving is going to advance and there's not going to be a car market for car insurance. And to put that in perspective, renters and pet insurance are something like in the US, $5 billion a piece right now. Cars, something, around 300 billion. So massive sort of upside if it's there. People say, hey, the full self-driving is going to advance and there's not going to be any driving will be perfect and nobody will need insurance for their cars. And, this will squash this sort of opportunity. few sort of pushbacks on that bear thesis. For one, pet insurance is growing rapidly. Like even if you look at Lemonade's, what they laid out in their last investor day, what their plan, they sort of showed a 10x plan over the next probably 8-9 years. 4 billion of that was going to be car insurance. So they go from 1 to 10 billion. 4 billion to be car insurance, and they're still saying 6 billion of their other products. Huge slice of that is going to be this growing pet market. So just to plug pet, pet ownership is growing. Pet insurance in the U.S. is tiny penetration. I forget, it's like a few percentage points versus some other countries in Europe where it's much more common. So people see the trends are that pet insurance is going to grow, and Lemonade could probably, you could have a thesis just on pet and renters and just on the back of pet being a very good investment. Now, in car insurance, I'm a huge Tesla fan, just like Jake Neal, and was still is a Tesla investor as well. And I'm bullish on their full self-driving rollout. But the way I see the car insurance market, it's a huge market. It's going to a few things. I think it's going to take time for robo taxis or full self-driving to really be produced, rolled out, and accepted. It's not like you could snap your fingers and replace hundreds of millions of vehicles with robo taxis. So there's a sort of a long horizon where you can see that coming, or that adoption coming. You can also, or I think you can argue that there will be some percentage of driving that won't be, that maybe it's like that people just want their car with all their tools set up inside of it. So they're some kind of tradesman or whatever it is, and they're doing something and they have their truck set up just how they want it. So they're always going to be driving that vehicle themselves, or at least insuring it themselves. They're not going to be using it in that, so there's going to be some slice of the market that's still going to need full insurance like we would now. And then the way I see it is that there's still going to be other forms of risk that even if you own, say, a fleet of 100 or 1,000 robo taxis, you're still going to want coverage for. Maybe it's hail or environmental damage, or your cars are parked overnight and they get pelted with hail and damaged. There's still going to be, that 300 billion now is still going to be a massive pie, even in a world where full self-driving is robotaxi sort of is saturated in that. So that's that is one that I hear very commonly. People say, oh, they don't have any upside. Full self-driving is going to just roll out, expand, and then they'll be upside limited in that way. But I think, the other products are still going to be huge, especially pet insurance. And then I still think the car is such a huge market, and you're thinking globally. You're not even just thinking like just the US. Their ambitions are for globally. It's like you think driving all over the world. It's just such an enormous market.
Europe's never going to have full self-driving cars, so
we'll see. I guess.
No, I'm just kidding. But the other thing is, until it's actually illegal for humans to drive on the road, it's like autonomous cars are going to keep getting in wrecks because there's going to be crazy humans on the road. So even if that becomes less frequent, and those premiums go down, I think Neil might have been mentioning this in our X Spaces earlier. When the actual premium for car insurance goes down because wrecks are less common, you still have, rock slides and stuff that you're going to have to insure for, flooding, but the premium will come down if crashes become less common. At that point, the advantage that Lemonade has in operating cost is going to make their pricing advantage even larger. So when the total premium is less and operating expenses make up a higher percentage of that total premium, having those operating expenses automated by AI means that Lemonade's pricing advantage can actually grow compared to incumbents. And then the other thing I want to mention is that car is just upside for Lemonade. Like if you're Progressive and you have 10% of the auto insurance market now, like it might be really scary to you if auto premiums get cut in half because of autonomy. But if you're Lemonade and don't have any of the auto market yet, it's like it's all upside. It doesn't matter how it's going to change. I think they're going to be able to execute really well. They're smaller, so they're going to be able to pivot and change to however the market is looking really well. And I'm actually a robotaxi owner. I have 5 Teslas that I'm planning on putting into the robotaxi network. They're all going to be insured with Lemonade. So they're going to be insuring the autonomous taxi fleet in many ways cheaper than Tesla Insurance wants to charge me. So this thing on screen right now, sorry, Amit, this is really big. I don't think people get this. So this was shared at the 2024 Investor Day. Back then, a third of Lemonade's total car insurance premium sales were organic. People just searching for Lemonade car insurance, or who had previous like pet or renters and then adding car insurance without any additional advertising cost. The other thing that's crazy is right now Lemonade is not in many states in the United States. So they have an insane wait list of 700,000 people. This is, they joked at the Investor Day, this isn't like a new Jordan drop or something. Like this is car insurance. And they have a 700,000 person wait list to try and get Lemonade car insurance. Because premiums for car insurance are bigger than premiums for pet and renters, this wait list, now all of them are not going to convert, obviously, but this wait list is more total premiums than Lemonade's total current premiums, like that they're bringing in annually right now. So this represents a ton of future organic growth, very low cost or no cost, that could just double the business.
Right. I think what's interesting right here as well from all three of you guys is the level of passion you guys have for the name. Can you speak a bit towards the retail community? I mean, at the end of the day, it is insurance. It's a boring business. Why is there such a retail cult following around the stock?
Paper bag invest.
Yeah. Hey, Greg, you want to take this one?
No, you can go for it, Neil.
I can jump in and start, whatever. Yeah. Why? I mean, we think the thesis is right. I mean, just like Jake said, it's like we're here. We feel like we're doing everyone a favor just talking about Lemonade. We're excited and passionate about it, but we're not trying to pump up the stock or something. It's like regardless, we think this thesis is going to play out. Just like Neil said, he has 90% confidence that they're going to execute towards this vision that they have. I think so many investors, in our group now on Twitter started, I think we just passed 3,000 people there. And it's growing really rapidly over the last, couple months here. But so many people in there, are sort of all in investors in Lemonade, where they've done deep dives, been following it for years. Some of these people, like we've been communicating with for 2, 3, 4 years, and following this in complete detail and saying, look, it's just a matter of time before they scale out of all this upfront investment, and then you reap these massive profits start coming. So I think that's why the passion is that there's a lot of us that have looked deeply, and we feel, we have a high conviction that this is going to come true. So,
I think just to add there, I think the other thing is that, retail individual investing has really changed, right? And I think, Amit, you're a big part of this as well.
Mm-hmm.
Like a lot of the insights that were, primarily sat with the actual analysts at, buy side, sell side firms, that information is now available to everyone. And I think that this community of Lemonade investors, they're not just sort of coming in with like, this pump mentality. This is a cool meme stock, things like that. It's like a lot of people have brought a lot of intellectual rigor to really dissect every different angle that you can look at this company from. And I think that the community collectively has done a fantastic job in really doing that. Like we've drawn out so many different arguments from people, again, collectively, and address them. And I think when you can sort of look at the quality of the bearish takes, and then you sort of look at your bullish thesis and you sort of like bring the two together, I think that's what ignites the passion for a lot of people. Like, look, don't get me wrong. I think Lemonade is not one of those things that it's going to click in just 90 minutes, right? It's one of those companies where you really have to digest a lot of information. You got to sort of like synthesize it in your mind, think through it all, really apply different mental frameworks to how you look at it. And I think for everyone, there's typically this moment where the whole thing sort of clicks. And I think that moment for a lot of people is very powerful, because once it clicks, it almost becomes an obsession because you're like, oh wow, this is crazy that what I'm looking at. How am I wrong? Where am I wrong? And you really start to go out there to look for reasons why you might be wrong. And I think one of the reasons why the passion is really strong within the community is because so many people have gone out to look for those, how can I be wrong? And then we've seen the counters to a lot of those points, and they don't really hold a lot of water. And I think, again, I'll sort of say this again because I think it bears repeating, which is the alpha here with Lemonade exists between this current perception and this emerging reality that's going to be backed by the numbers, and it's going to be undeniable at that point. And I think a lot of people are excited about that. And I think you're going to see, as we've seen with many other stocks that have misunderstood narratives, when that like existing entrenched narrative breaks, you tend to see a lot of upside. I think that's the case with a lot of investors with Lemonade. They're here for that, that alpha to sort of come to fruition, where the current perception breaks, and that emerging reality becomes the new perception. And I think it's just a matter of time.
Yeah, I think another thing that's caused the Lemonade community to just be like rabidly passionate is the fact that the leadership has embraced the retail community in a way that you don't see that often. You did see it with Palantir, you saw it with Robinhood. You've been this, like, very central in that. But the fact that the CEO, the co-founders have sat down with Neil and Paperbag because they appreciated the research that they were putting out on X and YouTube speaks volumes to the type of founding team it is. When I started tweeting about X in the last couple of months, Shai literally reached out to me and was like, hey, thanks for the support. I got to correct you on a couple of these things so that you're sharing good information. And I was like, that's so cool that the founder of this, $3 billion company cares enough about the narrative around the stock that he would send me messages letting me know more accurate information to make sure that I'm as a voice for the retail community, sharing the right information. Like that is incredible. That shows you the sort of like leadership team that exists at the top.
Maybe add a little anecdote to that too. Both investor days, it's been really, really great. Shai and the other management team, after the investor day is over, later that evening, they've organized drinks with all the retail community. So the first investor day was like, there's, I don't remember, 10 of us there, and Shai and one other management person, and just be able to pick his brain and talk about the company and his thoughts in more detail. And then the last one, just in November, was all the management, and just there's more retail there at that one. So just like you said, yeah, totally. And they're super, super welcoming and embracing of retail. So yeah, that's only just added so much fuel to it. So.
All right, there we go. Lemonade. That is our third deep dive. We will see kind of how people think of this deep dive and how they dive into the numbers. I think to sum it all up, AI is central to the thesis. Not profitable, but there's a reason they're not profitable. They're sacrificing profits for future growth. And ultimately, if they're able to continue the growth fueled by AI, which the legacy incumbents kind of can't just do, a $3 billion company theoretically doesn't have to be $3 billion 10 years out. There you go.
We're going 100x, 1000x. That's my opinion. I mean, I think so 300 billion is not crazy. If you look at Progressive as an example, Progressive only does car insurance, only in the United States. They have a couple of policies in another country, but it's like 99% US, 99% car. They're worth like $160 billion with 10% of just the car market. Lemonade is not only in car, they're in, they're trying to cover every single insurance product that they possibly can. They're also not only in the US. And that's why I'm saying, like, Lemonade could have a smaller slice of the total insurance market that they're going after than Progressive currently has of car just in the United States. With 5% of the insurance market and the same valuation multiples they're trading at today, Lemonade is worth over $1 trillion. With 5% of the global insurance market. Like, that is not big. Especially when I think they're building, monopoly-sized moats here. So if you start to look at a situation where they take 20% of the global market or something like that, you're looking at one of the most valuable companies in the whole world. And it's $3 billion today. And like if they just matched Progressive, they failed every single product except for car insurance. They only took 10% of the car insurance only in the United States. They failed everywhere else. And they just had slightly higher profit margins than Progressive. You're looking at 100x.
All right. There we go. Thank you, Jake. Neil, Paperbag. One just final disclaimer. None of this was financial advice.
Yeah.
This was just all retail investors trying to come
Not
up with a
personal
thesis.
financial advice.
Yeah, not personal financial advice. If you guys do choose to buy this stock, it is kind of based on the DD that you've done. And if you don't, then that's fine as well. But obviously, there are a lot of risks to investing in any company. But hopefully, this past hour was good enough to lay out what the bull case could look like for Lemonade. Thank you, everybody.
Thank you so much.
Thanks for having us, Amit.
Yeah, thanks for having us. It's
Yeah,
great.
everyone's Twitter is in the description. You can check them out. They post about Lemonade pretty much every single day. Have been for the past couple of years. And we'll keep going from there. Thank you, everybody.
Thanks, Amit. Thanks, everybody.
Thanks.
Yep, thank you.